Good afternoon, everyone. We're going to get started in the next 30 seconds to a minute. We have some people logging in, so we're just going to wait just a minute real quick. Thank you. All right, it's 2:01, so we're gonna begin. Hello and welcome. Thanks for joining us today for On Beyond Fiduciary, Effective Plan Governance. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged in to the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continued education credits are being offered for the following designations: CFP, CIMA, CPWA, CIMC, RMA, and SHRM. At the end of the webinar, we would like to request that you fill out our evaluation form. It's going to pop up on your screen at the end. We'd really appreciate your feedback. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can. We want to be respectful of your schedule and end on time. If we don't get to your question today, we'll definitely follow up with you afterwards. Tomorrow, you'll receive an email with a link to replay today's broadcast. Let's get started. Our instructor today is Rich Rouser, Senior Vice President of Thought Leadership at Pentegra. Rich has more than 30 years of experience in the retirement benefits industry and is responsible for helping to shape and define Pentegra's viewpoint on workplace retirement plans, plan design strategy, retirement success, and employee savings trends. Rich, thank you so much for leading our class today. Let's talk fiduciary.
Thank you, Beth, for the introduction. Thanks, everybody, for attending this afternoon. We've got a pretty robust program put together covering pretty much every aspect of fiduciary as it relates to qualified plans that we could think of. So we're going to dig in. We've got a lot to do this afternoon. As Beth said, please submit any questions you may have along the way. We'll probably try to answer most of them at the end is what we're intending to do. So a couple of things that I want to start with, which is what are the learning objectives that we're going to cover this afternoon. Basically, we want to make sure we give everybody a great understanding of the importance of retirement plan government process. What does it mean? How do you accomplish it? How do you get it done? How do you document the process and everything else? So we're going to dig into a lot of that. We're going to work on giving you assistance, right, as whether it's as a plan sponsor or as part of the retirement benefit committee, to basically enable you to better serve the participants that are in your qualified plans and to enable you to more effectively work with your various service providers. So we're going to go through also, comes up, I guess, pretty much closer to the end of the presentation, some potential conflicts of interest you ought to be aware of. And then we'll dive into some of the conflicts that can occur occasionally between the laws, the rules, the regulations, and plan documents. You know, one thing I always kind of start with when we get into that element of the discussion is, you know, if there's ever a question on what to do, the first place to look is the plan document. But again, we'll explore that a little bit further and get into the details behind that. And kind of the last thing that we'll talk about is educational needs of anybody that may be on the retirement plan committee. because there are fiduciary roles being assumed by whether it's committee members or even some folks within the client, the plan client's organization, who may be actually serving in certain fiduciary capacities. So we're going to talk about that also today. So with that said, we're going to talk first, what are the responsibilities of the various plan officials? We will then talk about elements of plan governance and things that go into that part of the equation, and exactly who's responsible, right, for creating a governance plan and program for the plan in question. So I know, at some point we'll get some questions on some of these elements, because not every qualified plan in the marketplace, right, has a really super formal process. Some of these things that we're going to talk about today, you don't necessarily have to have, right, super formalized, but truthfully, the recommendation is to have a more formal process for almost everything. And you'll hear me say to document things, right? Documentation of actions taken with respect to any qualified plan is kind of key. And I'll explain why in a little while here. So really identifying, who's involved with the governance process. And again, there could be internal colleagues. It could be, potentially part of the board of directors of the organization. And obviously, external service providers can also play certain roles. So again, we'll take a deep look at that. And again, as I said earlier, what does a good governance process look like? And how do you put it together? How do you construct it? How do you monitor, maintain, and manage it over time? So that's kind of the beginning. That's kind of the beginning of where we're going to go today. And so let's think a little bit about the responsibilities of what I'll call plan officials. So again, this ties very heavily into the fiduciary aspect of running a qualified plan. There's something called an exclusive benefit rule, right, where fiduciaries have to operate in a way that benefits plan participants, and also looks to the reasonableness of fees. So I'll give a couple of comments on that right now. A lot of times there are senior officers of the entity, right, the plan sponsor, who are playing a role as a fiduciary and making decisions with respect to the operation of the plan. So the one thing I always say is, in the role of a fiduciary, you really have to take your other roles or hats off, right? In other words, if you're CEO or CFO or head of human resources of the company, you kind of have to kind of step back from that corporate role and look at the fiduciary role as it applies to the plan. And what that means is, a lot of times I'll say, you need to look out for the best interest of the plan participant, really, because that's really the objective of the fiduciary role, which is to protect plan participants. Now, what I'm not saying is that, hey, if there's a question or a gray area, I'm not saying every decision has to be made in favor of a plan participant. However, what I am saying is, you need to make sure that you're fair and balanced in terms of decision making, right, as it comes to fruition with anything that may be gray or unclear. Prudent expert rule: fiduciary actions in the plan are going to be held to a standard of an experienced professional. So what that means is, if you're a fiduciary or acting in a fiduciary capacity, you don't necessarily have to have the exact personal knowledge and insight and intuition to be able to do every function required. However, right, just like anything else in business or even personally, right, if you're not qualified to take on certain tasks, there's really only two recourses. One is to hire somebody, right, professionally to help fulfill that obligation or that role, or two, become educated sufficiently in that matter. So, it's really incumbent upon fiduciaries to understand the fiduciary status, and their fiduciary obligations. And I will talk a little bit more about this aspect this afternoon. Then there's plan document rules, and I touched on this earlier. Plan document is really the roadmap to how the plan operates. I frequently get questions on, gee, what do you do in this case? Or what do you do in that case? And it could be something as simple as, hey, a participant wants to take a loan, or a participant may want to take an in-service distribution, right? They're still actively employed and have a need for some of the money, whatever it may be, and want to take money out. Well, the first step is look to the plan document. The plan document is going to be typically, right, crystal clear with respect to, can you do it? Can you take the loan or distribution or not? The other thing to note is even if a plan document says, no, you can't, and in this example, take a loan or take a distribution, it may be possible to amend the plan document as long as it's, within accordance of the law, IRS rules and regulations and the law itself, ERISA. It may be possible to amend the document to permit that if it makes sense to do that. The other thing that you should know about plan documents and plan features is that you can't, in general, you can't discriminate. You can't kind of pick and choose which participant gets to take advantage of, certain aspects of the plan. So again, the fiduciary role ties into doing things fairly, doing things prudently, and in all cases, acting in the best interest of plan participants. But again, I always say, hey, if there's a question on what to do, look to the plan document first. It probably explains it there. The last bullet on this page is investment diversification rule, and we talk about this in a couple of different contexts. In general, right, the plan, and therefore a fiduciary who's making decisions on the investments, should be offering a wide range of investments, right, for the participants in the plan. And we'll take a little bit of a deeper dive on this when we talk about potentially outsourcing that role. But, there are a lot of qualified retirement plans where a retirement plan committee or an investment committee of the plan, right, made up of typically internal folks at the company, may in fact be responsible for that function. In the old days, and I mean kind of really old days, there used to be plan assets, even in the DC world, defined contribution world, used to be managed by a committee, right, for the benefit of everybody, kind of on a commingled basis. We don't really see a lot of that anymore, but that does exist. That concept of investment management does exist more so in the defined benefit marketplace these days, because there's no individual account balances, right, in a defined benefit pension plan. So it's important to understand the investment role that any fiduciary takes on. We'll talk a little bit about, or maybe a lot, a little bit later, about potential outsources of that role in and of itself. So those are the basic elements. So just to, here's kind of a checklist, right? What are the roles here? What are the obligations? Select and monitor plan service providers. And I mentioned earlier, if the fiduciaries who are governing the plan don't have specific knowledge or expertise, they're typically going to hire somebody who has that expertise. And again, we'll go through some more examples, but obviously in the 401k world, it could be the record keeper. Typically the clients are not going to do their own record keeping on a 401k plan. It could be the investment advisor to help with that side of the equation. It could be a third-party administrator, right, a TPA type firm who may be doing testing and compliance and all that sort of thing. So those are all service providers. And again, the one thing to be really aware of is realize that those are just service providers, right? They're not necessarily, and in most cases are not, shouldn't say most, in many cases they're not a fiduciary. The exception there typically is the investment advisor. Again, we'll get into that a little bit more in a few more minutes. Again, operating the plan in accordance with governing documents, laws, and regulations. We talked about that earlier, critically important. That's the first source to solve any sort of a problem in terms of, gee, what do I do and how do I administer a certain portion of the plan? So again, a lot of plan sponsors will rely on the TPA, third-party administrator, to help, right, to understand plan documents and the meaning of the various provisions and the actions that can be taken. But again, realize that they're acting in a service provider role, not in a fiduciary role. A third bullet on the left side of this slide, ensuring reporting and disclosure requirements. Basically, most qualified plans have to file a Form 5500 annual return report each year. In conjunction with that, there's various testing and compliance elements that go into answering some of those questions, and also whether or not those questions on compliance are on the 5500 or not. Compliance testing is required for many elements of a qualified plan. And again, most plan sponsors don't do that testing and compliance or even completion of the 5500 on their own. They're typically outsourcing third parties to do that work. Last bullet on the left side, build, maintain, and document the plan governance process. You're going to hear me talk about documentation a lot today. And it's critically important, when you're acting in a fiduciary capacity, to document, right? Document actions taken, conclusions reached, things of that nature. Because, if there's a conflict or a challenge to a decision that's been made somewhere down the road, and in many cases, it's not just a couple of days after a decision, it could be a year or two or three, right? You want to have clear documentation as to what you did, why you did it, and in many cases, that will alleviate some legal conflicts that could be put upon you down the road. Starting on the right-hand side of this slide, overseeing plan investments. Again, I mentioned, some clients, plan sponsors do that themselves. Many others outsource. I'll start to throw around the technical terminology to an ERISA 338 investment advisor, right, or an ERISA 321 advisor. And there's differences in how they operate, but the bottom line is it's you're either going to outsource that or keep it internal. If you outsource it to an ERISA 338, they're typically taking on a fiduciary role, right, in terms of how they're managing plan assets and going through the process. Again, we'll talk more about that later in the presentation. Next bullet, keeping plan docs up to date, documents up to date. Unfortunately, we see all the time clients that come to us with an existing plan. The first thing we do is take a look to make sure everything is in good order. And that usually starts with a review of the plan documents and some of the other notices and other requirements that need to be made by each qualified plan. And frequently we unfortunately find, an interim amendment that was required by law might not have been done timely or might not have been done at all, quite honestly. So there are ways to fix things like that, but it's, again, critically important to make sure plan documents are kept up to date with law. And just to kind of tip my hand a little bit, there's kind of a biggie coming for the entire industry. Well, a couple of things. In the defined contribution world, a lot of defined contribution plans need to be restated, by next year. But the biggie I was alluding to is, right, with the CARES Act that was passed in March of 2020, right, in the early stages of the pandemic. The CARES Act allowed qualified plans, primarily 401k plans, to allow loans that were as much as 2 times the normal loan limit, allowed in-service distributions for COVID-impacted participants and or beneficiaries, right? So as part of that legislation, plans were able to adopt, right, those CARES Act features, whether it was a loan feature or distribution feature, with the understanding that you would be required to do an amendment, a formal amendment to the plan, no later than the end of the 2022 plan year. So, there's something out there that I suspect, as we eventually get into 2023, that we're going to start to see some plan sponsors who actually did adopt CARES Act features, did provide those benefits to their participants, and somewhere along the way kind of forgot to do the CARES Act amendments, right, that are required. So it's kind of a biggie that's coming up that anybody who maintains a plan should be aware that needs to be done if they took advantage of CARES Act features. Avoiding conflicts of interest. Yeah, we'll spend some time at the very end talking about that and what that means and how to avoid it. And the last thing to talk about today is how do we make sure that each fiduciary, certainly on the plan sponsor side of the equation, right? How do we make sure those people are well informed and make sure they can be effective in their job and are fully trained, if you will? And if they're not, how do we fix that issue? So I'm going to talk next about a governance policy document. I don't necessarily see a lot of qualified plans out there with this. We as an organization act as an ERISA fiduciary for a lot of plans. So we have our own process, procedures, and controls. But for a client that is maintaining the responsibility to be the principal fiduciary of the plan, I don't necessarily see a lot in terms of written process, procedures, and controls. So, part of that is delegating authority to various individuals that are responsible for the plan, meaning, is it the retirement plan committee? Is there an investment plan, committee that ties into the plan? Are you delegating certain fiduciary functions to different individuals within the organization, such as the CEO, the CFO, maybe a board of directors, and or those committees I mentioned earlier? So a policy document would kind of define the roles and the responsibilities of the various parties, and it would assign, I think I flipped to the next bullet here, assigns the duties and obligations of those responsible parties to make it crystal clear who's doing what and what they're responsible for. Because again, one of the issues that we typically see in this arena is plans may have individuals within their organization acting in a fiduciary capacity where they don't really even know that they're a fiduciary. So critically important to identify these folks, assign duties and responsibilities, and make sure they're totally aware of it. And then, this would go through also, this document would go through what actions need to be taken, to the plan that get approved by which group, the investment committee, the retirement committee. Do certain decisions, are certain decisions acted upon by the board of directors and the entities? So, defining who, what, and how really is kind of how I sum up this slide. In a written document would be a good thing to have if you don't have it, and particularly if you're assuming those duties and obligations internally. The document would also talk about how frequently various parties meet, and it would identify recurring agenda items. So, we attend a lot of board meetings that get into the fiduciary process of the plan. And there are recurring themes, in the first quarter of a year, just to throw out some examples, we'll talk about last year's performance and kind of do an overview of the various service providers. In the fourth quarter of each year, we will typically do an update, educational kind of an update for folks in terms of fiduciary duties and responsibilities and what it means. So things like that. There are various, again, items that come up at various times of the year, and that would be fine. And, if you can put that into a document, governance document, that's great. I'm not saying that has to be the beginning and end of everything and very, very rigid, but it could be as simple as saying, hey, at least annually, we're going to review X, Y, and Z elements of the plan. So, kind of detailing and documenting it, kind of make sure you don't miss things is the point. And again, the last window that I put up here talks about documentation, which is critically important in terms of recalling even what was done at a certain point in time. So we're going to talk now about creating and executing the governance process. So here, this is actually a question. We didn't set it up as a polling question, but I'm gonna walk through it as if it is. I'm gonna ask you to think about, as I put a couple of cards up here, who's responsible for executing and creating the governance process? Is it the plan's record keeper and or the advisor, and or a third-party administrator? right, who might be doing a lot of work on the plan, the ERISA 338 investment fiduciary, or none of the above. So, if we were doing a real polling question, I'd ask you to select one of these, and no surprise, the answer is none of the above. So I'm going to go back a slide, right, just to put them all up there, right? So if you thought your record keeper was responsible for the governance process, no. The advisor, no. The TPA, no. The investment fiduciary 338, no. It's really you, right? You're the plan sponsor. So ultimately, it means that you are responsible for the governance process of the plan. And, at the bottom of this slide, we're saying duty can't be delegated, right? But you can get help from the plan committee. But a good portion of this can actually be delegated, right? It's possible to delegate fiduciary functions and duties to a professional ERISA 316 plan administrative fiduciary, or I hate to get so deep into the buzzwords, but ERISA 402A plan fiduciary, which is really kind of the role that the typical plan sponsor sits in each and every day. So you can actually outsource certain components, but even then, right, the couple of things that you are still responsible for, even if you're outsourcing fiduciary duties, is to monitor that service provider. Make sure they're the right one, make sure the fees are reasonable and correct for your situation, make sure they are charged with doing what you think they are doing, right? Because I see a lot of fiduciaries in the marketplace who don't really do it all, right? So make sure you know what you're getting, but you're still responsible for oversight of those folks in terms of the process. Okay. Wait, did I go too fast here? Right, okay, one more slide. Okay, so the governance team, again, does everybody on the team understand their duties, rights, and obligations? Who are the plan service providers? We touched on that a while ago. I'll bring it up here again in a second. Does the plan sponsor and the committee understand, right, the type of services needed? And then you got to figure out which, if any, of the service providers are offering fiduciary services. So we'll walk through some of these elements coming up here, right? So, so again, the plan committee has the duty to monitor and evaluate fiduciaries and service providers. And again, it really has to be done at an expert level of understanding. So again, if you need help in that area, it's important, critically important, to seek guidance, seek help. A, number one, make sure you're doing the right thing, and B, protect yourselves legally, from certain responsibilities. So now we're going to break down again into service providers. So again, 401k space is primarily what we're talking about this afternoon, although it could just as well be a defined benefit plan. There's a record keeper for any defined contribution plan, typically a record keeper because you're doing daily record keeping. There is the third-party administrator. And again, that's the firm who is, and by the way, certain record keepers also can act as a TPA, third-party administrator, right? So the TPAs are the ones who are typically doing, benefit calculations for participants who might terminate employment. They're preparing the Form 5500 annual filing. They may be working with the audit firm if it's a large plan, right, where the audit is required. They're doing undoubtedly testing and compliance, right? Whether it's an ADP test or an ACP test, right? The matching contribution test. They may be helping with the allocation of profit sharing, or additional supplemental contributions to the plan. They may be helping with your definition of planned compensation, which is probably one of the biggest failure points that we see in qualified plans, where not everybody truly understands what the exact definition of compensation is as outlined in the plan document. But let me not get too deep into that yet. So the TPA typically will fit into a whole bunch of different technical roles to help you support your plan. But the one thing a TPA is not, nor is a record keeper, they are not fiduciaries, right? They are just service providers. And really, what I'm getting at is you as the fiduciary are responsible even though you've hired a professional to do some of the work. Custodian is holding plan assets. Again, they will act to a degree in a fiduciary capacity, but a very limited scope in terms of what they're doing. Same thing with the plan trustee. There are certain fiduciary duties there, but again, very limited to what's happening on the plan asset side of the equation. The advisor could be the plan's advisor, if there is one, right? Could be acting in a variety of different roles. They could be acting in a consultative role, right? Maybe more in terms of plan design, plan pricing, searching out pricing comparatives, and also maybe employee education, right? But other fiduciary advisors, and by the way, those are not necessarily fiduciary roles, the ones I just described. However, if the advisor is working as an ERISA 338 investment advisor, they would definitely be taking on a fiduciary role with respect to selecting, monitoring, and recommending changes of the investment mix and actually executing those investment changes. The other role we sometimes see advisors in is the ERISA 321 role, where they're doing much of the same work as an ERISA 338, but the only difference is you, the employer or plan sponsor, or the retirement committee or investment committee, right, own the responsibility of taking or not taking a recommendation from an ERISA 321 advisor. So, they'll research, they'll select funds, they'll monitor, but not formally select them, right? They'll wait for the plan sponsor to sanction the use of any one investment. So it's kind of a bifurcation of the fiduciary role within ERISA 321. There could be a pure, I mentioned this a little bit with respect to the advisor, but sometimes there are plan consultants. They don't necessarily call them advisors, who work on some of the things I mentioned earlier, right? Plan pricing, plan construct, benefit features, maybe even selection of various service providers. And then there are other potential fiduciaries that could come into the mix. So these are all, by and large, service providers. And in some of them, there is some limited, I'll call it limited scope fiduciary role. But again, kind of going back to that governance document that I mentioned earlier in our discussion today, one of the things that we normally recommend is to have what we would call a chief governance officer. Somebody who is kind of the lead in terms of whether or not it's forming the committee or running the retirement plan committee or heading up the investment committee, or maybe just appointing people to be on that committee. But somebody who is responsible for actually going out and retaining the record keeper and the third-party administrator and or a custodian and trustee, so on and so forth. It's great to have a point person. And again, we see clients who operate in this manner who may rotate that lead. But typically you want to have a lead of the groups to make sure that you're communicating effectively with the various fiduciaries and or service providers. And by the way, you could actually have more than one. I can see this being divided into two camps, one who might be more of a lead on the investment side of the equation, and one who might be more of a lead on everything else operational with respect to the qualified plan. And again, this is not really limited to just 401k, even though that's kind of what we're talking mainly about today. This applies really to any qualified plan, whether it's a defined benefit plan or a target benefit plan or a cash balance DB plan or any of those. All of those have functions that need to be fulfilled by various service providers. Okay, so committee meetings. We've talked a lot about the governance process, but what does it really mean to do a committee meeting, and what are the agenda items, and is there a process, and what are the dates and times, and are there minutes and notes to the meeting? Typically, there will be follow-up action items. We probably couldn't fit more arrows on this slide, but typically I see action items that need to be followed up on after each of those committee meetings. So, it's a process that takes time and effort internally to go through this and to make sure that you're hitting all the right things and to create the agendas, a lot of the agendas are going to center around investment performance, right? So if you're interfacing with an ERISA 338 or an RIA, or 321, there'll be a sit down periodically. And by sit down, whether it's in person or virtual or over the phone, it doesn't really matter. But typically some sort of a review of the investment components of the plan, and excuse me, including some benchmarking and some of the attributes of the funds. Also, looking at pricing of the investments is critically important, right? Because as a fiduciary, you need to act in the best interest of plan participants, and price comes into play. The one thing I will say is that the Department of Labor, who was kind of the enforcer, if you will, of the rules, right, has always said, pricing is critically important, but you don't necessarily have to have the cheapest service provider in each and every category. So, even though we talk about pricing and benchmarking fees and all that, really looking at value for the services provided. Because when I look at service providers across the industry, there are some that are very, very high touch and warrant a higher price to be paid for their services. And there are some that are very low touch, or maybe less responsible financially, let's say, for things that may go awry, right? So it's like anything else, right? Prices will vary, but you're not bound to choose the absolute lowest cost provider, because quite honestly, they may not be able to provide the level of service that you need for your plan. So, having some organization around this and structure around the committee meetings, I think is key. Certainly, you can see my last bullet here is minutes, which is minutes of the meeting, which is essentially documentation. The one thing in terms of qualified plans, when we see legal challenges, right, somebody accuses the plan fiduciaries of doing or not doing something properly. The one thing about ERISA, the law, governing law, right, surrounding retirement plans, is that, it puts the onus on the fiduciaries to do the right thing. And it doesn't necessarily mean that the absolute best outcome has to occur each and every time, but the mere fact that you consider something and look at something and make a different choice, right, based upon factors at the time, whether or not that ended up being the absolute best optimal decision down the road, it doesn't matter so much, as long as you can kind of verify that you actually had a process for doing what you did and that you document the process. So unfortunately, as I like to say, anybody can be sued over anything by anyone at almost any time. Having documentation as to what you've done and what actions you've taken, I think, is critical to kind of heading off trouble, as it develops. So I mentioned a lot of these earlier. ERISA 338, I kind of put it at the top. That's the investment fiduciary aspect of the plan. So an ERISA 338 will, seek out, well, number one, and I think I'll get into it in a couple more minutes. They're going to develop an investment policy statement that essentially is going to identify 6, 7, 8 different broad asset classes that might be suitable, for, let's just talk 401k plan for a moment. So there may be 8 different investment classes that make sense, and just some examples of those are, large cap growth, mid cap growth, small cap growth, international funds, maybe a variety of bond funds and or a stable value fund, and maybe a few others, and maybe also a target date series of funds, right? So defining asset classes is one of the elements of the investment policy statement, and one of the roles of the 338, but also then taking a deeper dive and looking at, I call it screening the funds, right? Which funds are suitable within each asset class based upon that 401k plan and or the goals of the plan sponsor as the fiduciary of the plan, right? What are you looking to accomplish and achieve? And then filtering through and coming up with a recommendation and implementation of specific funds in each of the asset class categories. But beyond that, the 338 is going to monitor the performance of those funds, and they're typically going to have criteria written in the investment policy statement that will, kind of trigger warning signs, right? If a fund is underperforming or if the peers are doing better, you don't necessarily jump ship right away, but there typically is a well-disciplined process by which, they'll go through before they recommend or make a change to the fund. Anyways, so I won't go much deeper into that right now. ERISA 321, as I mentioned earlier, is similar to a 338. They'll do the research. They'll typically help put together an investment policy statement. But the key difference here is the 321 is going to recommend certain funds to the plan sponsor and or the fiduciaries within that plan sponsor. So again, it could be the investment committee, and typically it's then the plan sponsor or the investment committee that ultimately makes the decision, the fiduciary decision as to which specific funds to use within the plan. And ultimately, if that 321 fiduciary comes back at a later date and says, hey, one of these funds is no longer meeting whatever the criteria was, and again, in accordance with the written investment policy statement, says, hey, it would now be time to change it out, and here are the recommendations for the change. It is now incumbent upon the plan sponsor, as the fiduciary, to make a decision and implement an action, So again, what I'm kind of pointing out is, there's a fiduciary role certainly played by the 321, but again, I said it earlier, it's kind of bifurcating the role. We unfortunately see situations where a 321 has made a recommendation for change, and the plan sponsor has failed to act, quite honestly. And the problem with that is it can, expose exposure to certain legal challenges and or liabilities, So I'm not saying good, bad, or otherwise on any of these. What I am saying is make sure you understand what you have, why you have it, and as I said in the very onset, what are your responsibilities? What do you need to do in order to do things timely and properly, and again, in order to act in the best interest of plan sponsors. So ERISA 316, that's an entity or organization that takes on the role of a plan administrator fiduciary. Now, again, I always caution people, please don't assume your TPA is an ERISA 316 fiduciary. In the vast majority of cases, they are not. Even though they prepare the 5500 and so on and so forth, they are not the fiduciary. Unless you have definitively outsourced that function, you retain the ultimate responsibility for that role. The bottom one, I'm not going to talk about too much, but a 408G is somebody who's giving personal financial advice at an individual level. And from our perspective, we don't get too involved with that, but it is another potential role that's out there for consideration. So I alluded to this earlier. Not every fiduciary service is created equal. Contract terms, what's covered, what's not covered. How does it work? What's the financial wherewithal of the organization providing a fiduciary service, Are they properly insured? Do they have E&O insurance? Do they have enough financial wherewithal to back up their claims in terms of being able to act as a fiduciary? Because potentially, to the extent that they don't, there could be some of that coming back at you, even though you've outsourced some of that legal responsibility and liability, if you will. So again, here's just a little bit of food for thought here. Right and wrong reasons to use outside fiduciaries, the right reasons on the left to augment skill sets, to use it for the administrative convenience. A clear example is ERISA 338 investment fiduciary. That to me is such a specialized area of technical competence that's required. Not every plan sponsor or plan committee can really truly take that on and really do it extremely well. I'm not saying it can't happen. It certainly can happen at that level. But again, it does take time and effort to be on top of that, is my point. And also, we should have put a little bullet there on the ERISA 316 fiduciary duties. So that's another aspect of potentially outsourcing some responsibility and therefore liability. But again, please make sure you're working with a firm that has been in that line of business for years, because I do see a lot of TPA firms over the last 3 years kind of just say, hey, yeah, we could be a fiduciary, and they don't really have any practical experience in doing that, serving in that role. And I'll give a little tip here. The easy part is understanding the rules and regulations, right? Because that's what a firm in that side of the market is typically responsible for day in, day out. But really, to put the fiduciary hat on and to make sure things go exactly as they should, that's a completely different role, and a role that they're not used to providing. Anyway, so on the right-hand side, a wrong reason is just to kind of blindly hire somebody to eliminate your fiduciary liability and responsibility, because again, I've seen service agreements from certain administrative fiduciaries, whether it's a 402A or ERISA fiduciary or the 316, that are 22 pages in length, and in between are 17 pages of exclusions that you, the again, critically important to not rely just on a buzzword that I'm hiring a 316 fiduciary and assuming that they're doing everything you think they're doing. So be careful is my point. There are good ways to do it, to outsource, and not so good ways. Couple of a couple of other things here. Are the committee members ERISA experts? The answer is probably no. They probably didn't grow up in the retirement services business. And again, with that said, if they've been on any retirement committee for any number of years, it's certainly very possible. It's certainly very possible that they have a lot of expertise and knowledge in how to do that. So, but again, part of what we're getting at here is, if they're not experts, please, we've got to get them some training. And that kind of goes back to one of the original documents that I mentioned early today, is, kind of a governance policy. I won't go on and on and on about it, but the point is, we need to help them, or you need to help them get the resources they need to fulfill their functions. And again, first and foremost is, who is a fiduciary in your organization, right? Because a lot of times that's not clearly identified up front. And again, in the middle box here, who are my service providers? What roles are they playing? And what resources do we need to give to folks to, so they can do their job, effectively? Again, fiduciaries are held to an expert standard. Ongoing education is needed, and also document the educational process. I mentioned we sit in on a lot of board meetings, retirement committee meetings, I should say. And one of the things we will typically have a discussion on, typically at the last meeting of the year, is the educational process, right? Just reminding everybody what the responsibilities are and what the roles are, and so on and so forth, right? So there are different ways of getting that information to those people. But again, sometimes outsourcing may in fact be the best way to accomplish that. So I'm going to talk a little bit now about plan investments, right? So, we do see a lot of litigation in the area of investments, and it comes in, I think, a couple of flavors. Many, many years ago, we used to see more of the situations of, you used investment funds that, lagged the top, the best funds in their segment of the market, right? In other words, I was damaged because, the funds that you used, were not as effective as other funds. More recently, we see things like fees related to funds in particular, right? There are various classes of investments, and typically there are cheaper versions of many of the funds available that, for the retirement portion of the marketplace. And again, things that can kind of go off the rails is if there are cheaper fund alternatives, right, within that same fund family, not so much the family, but the fund itself, if you are not on top of that, right, and again, I see more of this issue if plans are doing their own in-house investments selection. They may not be aware there are other fund classes available. They may not be aware that, gee, they've accumulated enough assets in that one fund to reach, qualification for another break point to get even lower fees. So those are some of the things that can kind of trip you up in terms of legal responsibility. The green bullet here, green arrow, is plan officials are held to a reasonableness standard. Again, I kind of said early, plan fiduciaries have a responsibility to act in the best interest of plan participants, take off the corporate hat, so on and so forth. Is critical. And sometimes we see, plan sponsors saying, well, I need to have my favorite mutual fund in the mix. Well, that may or may not be a best practice if that fund doesn't hold muster with other investments in that asset class. So, and there are other ways of handling things like that, but I won't get into that right now. And I think the arrow at the bottom of this, the investment policy statement, the IPS as I call it, I think it's important to have that document, and it's really a roadmap to how you choose and select investments, and what the process is to replace them. And it's just another way of providing documentation. Again, if you're doing this internally as the investment plan committee of the plan sponsor, great. Having that documentation, I think, helps a lot in terms of making sure you're adhering to an appropriate process. And again, most investment advisors that you work with are going to have an investment policy statement that'll help guide the work that they do for you. Reporting and disclosure, again, this is, I kind of said TPA firms are in the marketplace. Sometimes they're bundled together with the record keeper on a 401k. But the comment at the bottom, gee, I thought my TPA was doing certain things for you. At the end of the day, they are quote unquote just a service provider, and the buck kind of stops with the plan fiduciaries who are responsible for making sure certain things get done. And I'll just point out that some of the law changes that were very favorable, right, to retirement plans over the last 12 to 18 months, some of those law changes also put in exponentially higher penalties for failures on certain items. Certain penalties and fines that were $25 a day have now gone to $250 a day, and certain things that were $100 a day are now $1,000. It's by a magnitude of 10. They've increased fees, and it was really a way of quote unquote offsetting some of the costs that some of the additional tax breaks that the government was building into qualified plans. Collecting extra revenue on failures, points of failure, is a way of offsetting the loss in tax revenue for higher deductions that are taken to these plans. Anyway, something to be careful about, right? Again, reporting and disclosure goes beyond just 5,500. It's plan documents and amendments, IRS compliance testing, participant reporting, right? All those notices that you have to give to participants, whether it's a summary plan description, the summary annual report, and all that good stuff. Avoiding conflicts of interest, right? The Department of Labor in particular is concerned about conflicts of interest. And, this can come in a lot of different flavors, right? I'll pick on larger plans, right, that are required to have an employee benefit plan audit. A lot of times clients will use the auditor that's doing other audit work for the organization. And while there's no reason you can't do that, keep in mind, you've got to act in a fiduciary capacity with respect to the qualified plan, even when you're choosing an auditor. Now, again, depending upon, who's paying for the audit, is the plan sponsor paying for it or are the participants paying for it? So, as a fiduciary, seeking a competent auditor who's qualified to do employee benefit plan audits, and seeking reasonable pricing on that are critically important in that. And I'm just picking on that because, we haven't talked about that aspect of being fiduciary. Gee, choosing an audit firm for the plan, that's a fiduciary function, right? In particular, if you're passing costs along to the participants. Hiring, I think we have a slide coming up, certain family members to do certain functions. You got to be careful in terms of doing things at arm's length, on an arm's length basis is the point. So here I'm saying IRS also has rules on, oops, I went too fast, prohibited transactions. Right, so there are some very specific things that you can't do in the IRS's eyes. So here's the conclusion on this slide. Please avoid conflicts of interest. And there are ways around it, and doing things at arm's length, I think, really is the best way to do it. Just to give you an idea, parties in interest, right, that could, kind of get you embroiled in conflicts of interest. Anybody at the plan sponsor and or affiliates or subs that you may have. Anybody on the plan committee, right? Other plan fiduciaries and certain other plan service providers. The left bullet here is talking about family members providing services, right? Be careful there. So again, these are just some examples of some potential conflicts of interest. So be careful, right? Is kind of the word of warning there. Try to be mindful of not engaging in a conflict of interest. So let me pause for a second. I know we have a few more slides here, which is fine, but Beth, I know we're coming up on time. Do we have any questions that we should answer at this juncture?
No, we don't have any questions at this moment.
Okay. Right. So let me just continue with a couple of more things here. Documents and governance. Again, I mentioned this earlier. There's some interesting stories here. I've said this a couple of times today, right? Always look at the plan document for guidance on what to do. And a number of years ago, I was involved with an IRS audit on the plan, and it was kind of a weird anomaly, right? The plan document had a vesting schedule. If anybody remembers those old 10-year cliff vesting schedules, or maybe it was graded at the time, I don't really remember. But when we looked at the plan document, well, that's how the plan was being administered, with a 10-year vesting schedule. And at the time, this goes a ways back, the law no longer allowed 10-year vesting. You had to vest over no more than 6 years, maybe 7 years at the time. And the anomaly was that the plan document had an IRS determination letter, right, that said the plan is and was qualified, right, which was equally surprising, right, and quite honestly, because how could they give an IRS letter sanctioning a provision that didn't really make sense? Anyway, my really long story here is that the plan was audited, and the end result is the auditor said, look, we gave you, meaning we, the IRS, gave the client in that case sanction to use that schedule, but it is no longer appropriate. So in conclusion, what they did is said, look, we're going to let it stand through the current date. Anything henceforth has to be on the more favorable schedule. So I kind of point to that almost a little bit, or maybe a lot, as an outlier, but because again, I'm going to get a little more technical here, right? When you think about it, if somebody left non-vested or less vested under the 10-year schedule, what happens? Well, they leave some forfeiture money behind. And in this case, the plan was allocating those forfeitures to the remaining participants. So, even if the IRS agent said, no, you should go back and more fully vest those people who left, kind of would have been taking money away from the other participants who remained. It was a little bit of a dilemma, but I guess my clear example of what I'm trying to get to here is your first course of action is, what does the plan document say? And critically important as a fiduciary, and critically important, even if you're relying on a third-party administrator, right, TPA, to do a lot of that work. my advice is to be aware, to question things, to think things through, and make sure that you have the right service providers in place. So, Beth, with that, I think we are at time. So we'll end it here. I know Beth said she'll send out materials tomorrow. Beth, do you want to do some concluding remarks?
Right. We will be sending out an email tomorrow, so be on the lookout for that, where you can replay the broadcast. And just to remind everybody, when we sign off, you'll get a pop-up screen with an evaluation form. So if you would please complete that, we'd appreciate it. Rich, thanks for doing our presentation, and thank everybody for joining. Look for more CE classes to come. Thank you.
Thank you, everyone.